Does it work? Okay, very good morning. Welcome to this conference on about 20 years of macroprudential policy in Europe, looking back and looking ahead. It's jointly organized by the National Bank of Slovakia, by the Bank of Finland, and by SWERF. And my name is Rainer Martin. I'm Executive Director at the National Bank of Slovakia. And together with my colleagues, Ernest Knan from SWERF, and Susanna Fungacheva and Esa Jokivuole, I hope I got that right, sorry about that, from Bank of Finland, and Jan Klacho from the National Bank of Slovakia, I had the pleasure to organize this event. So we have 1.5 quite exciting, full, and I think interesting days ahead of us. So let's get started straight away with 2 welcome remarks. And the welcome remarks will be delivered by Peter Kazimir, the governor of the National Bank of Slovakia, and Maria Nikanen, acting governor of the Bank of Finland. Let me just say a few words to introduce them, and then the floor is theirs. So Peter Kazimir is governor of the National Bank of Slovakia since the 1st of June 2019, and as such, he's of course also member of the Governing Council of the ECB. Peter has quite a long career in public service in the Slovak Republic. He was Minister of Finance. He was before that also State Secretary in the Ministry of Finance, and he acted as Deputy Prime Minister on various occasions during his career. And Maria is acting governor of the Bank of Finland, and she has a long career in financial supervision, first of all. So she was Deputy Director General at the Financial Supervisory Authority of Finland for a couple of years, and before that, head of department in the same institution. And she also has a career in private banking. I think you worked in Nordea for many years, so you see both sides of the financial sector. So without further ado, I would ask Peter to take the floor. Thank you.
Good morning to everyone. Unfortunately, you didn't catch me at the best, So, ladies and gentlemen, distinguished guests, dear colleagues, I'm pleased to welcome you all to Bratislava here, really warmly. We have joined hands with the Bank of Finland and SWERF for this conference titled 20 Years of Macroprudential Policy in Europe. And these are extraordinary and staggering times for anyone dealing with monetary policy and financial stability. The last week, the ECB delivered the 10th consecutive hike of its key interest rates, and I sincerely hope it was the last one. As you see me walking on crutches, I think no hiking for me anytime soon is viable. We have traveled far in our fight with high inflation, and now it remains to be seen how forceful and effective the cumulative effect of our tightening really is and really will be. The jury is still put there, and we need a couple of months to deliver the judgment. Inflation, however, is not the only issue we are dealing with. Our economies are facing shocks unseen before, or at least not for a long time. The recent episodes of bank stress have proven that there are still destructive forces threatening smooth functioning of financial markets. There are still triggers that mustn't be pulled. I think it's the right time to sit down and reflect on our experience, our current knowledge, and the possible future of macroprudential policy that can help us through these challenging times. As we have been actively using macroprudential policy in Europe for about 20 years, we have more and more experience to evaluate and learn from. And this especially is the case of our central bank, the National Bank of Slovakia. Over the past 9 years, we have activated a wide range of borrower-based measures, and we are one of the most active macroprudential authorities or laboratories, if you want, in Europe. All this is in addition to mandatory capital-based measures. This is, of course, no coincidence. After the global financial crisis, my country experienced one of the highest growth rates of mortgage loans within the European Union. This, since 2016, has also been reflected in very, very dynamic, often double-digit growth of residential property prices. Such development, seen as considerable by international authorities such as ECB, IMF, ECRB, required a very proactive and prudent approach. Here I would like to emphasize that the possibility of implementing macroprudential measures at the national level has been an inevitable part of the successful macroprudential policy we have pursued. The national flexibility and the opportunity to tailor our decisions to the domestic market's specificities helped us design all relevant measures. I probably know that there are ideas and suggestions to centralize macroprudential policy at the European level. And here, I must say, I'm not sure it's the best idea. Coordination, yes, sure, but we need to be able to deploy country-specific measures where and when necessary. And it's also really very beneficial not to share macroprudential powers. And to be the sole proprietor, this is our case, allows us to be effective, on time, and efficient. Thanks to all the work done, we do not expect a significant increase in household credit risk, even in the current challenging environment. Yet we are not complacent and take very seriously that things could get worse, much worse, but we still have a lot to learn. Today, my country, Slovakia, has one of the highest home ownership rates in Europe. And it's necessary that the residential and commercial real estate markets, considered key markets, must be thoroughly analyzed and understood. Boom and bust cycles in these markets have long-lasting consequences for the real economy, for the households, for non-financial corporations and financial stability. This, together with possible structural changes imposed by COVID in the form of more home offices and less office space required, is an issue where thorough research supporting macroprudential policies can shed light on our unanswered questions. And honestly, I'm still not entirely convinced we fully understand what's happening in Europe's real estate markets. We need more data, enhance analysis, and run scenarios to grasp possible events and impacts better. But enough of me on this. There are so many well-equipped speakers here today ready to dive into the ocean of macroprudential policies, and Maria Anikainen, acting governor of the Bank of Finland, vice governor, is definitely one of them. Maria, welcome, and the floor is yours, please. Thank you.
Thank you, Governor Casimir. Ladies and gentlemen, dear friends and colleagues, welcome to this conference. Let me first convey the Bank of Finland's congratulations to our host, Narodna Banka Slovenska, on its 30th anniversary. It is a great pleasure for us to organize this conference with you and with our friends in Suerv to celebrate your important milestone. I would also like to use this opportunity to thank all those in your central bank and in Suerv and the Bank of Finland who have helped make this event possible. It is personally a great pleasure for me to be back in Slovakia. Your country has a special place in my heart because as a teenager in the 1970s, I spent several weeks on a youth camp close to Banská Štiavnica in the former Czechoslovakia. In those days, traveling was not that common, and it was really my first time abroad. I'm proud to say that getting to know people from other countries, from other cultures, was a key part of this. 40 years later, I revisited the beautiful town of Banská Štiavnica, which brought back a lot of great memories. The town, as you may know, is today a UNESCO World Heritage Site due to it having been a historically important center of mining industry. The topic of our conference, macroprudential policy, particularly in Europe, is as timely and topical as ever. It is also a good moment to take stock of the past and to look ahead, as the title suggests. What have we achieved and what do we need to focus on moving forward in this relatively new area of financial policy? Bringing together a wonderful group of experts, both from academia and policy institutions, is an excellent way to find out. The past decade has provided a variety of challenging circumstances for macroprudential policy. These have included different phases of the credit cycle, large external shocks, such as the pandemic and Russia's war in Ukraine, and very different monetary policy regimes. These cycles, shocks, and regime shifts have perhaps played out somewhat unevenly across different member states. We should not shy away from making our first assessments of how successful macroprudential policies have been in these varying circumstances. With these few observations, I would like to join Governor Casimir in warmly welcoming everyone and thanking our speakers for their forthcoming contributions, which we all look forward to hearing. Let's be sure to have lively discussions and exchange of views so we can learn as much as possible from each other. May I wish you a very pleasant and productive event. Thank you.
Thank you, Peter. Thank you, Maria, for these welcoming words and for already setting the scene and giving us some ideas that we will discuss over the next day and a half. So we're moving now to the first keynote speech, and I have the pleasure to introduce Javier Suarez. Javier is a full professor at CEMFI, the Spanish Center for Monetary and Financial Studies in Madrid. And he's been there for quite some time, I would say. But he has also been working at other very important universities, Harvard University, London School of Economics. So it's really quite an impressive academic CV. But on top of that, what is very interesting is that Javier has always been very closely involved also in the policy making. So he has been, he still is actually a member of the Advisory Scientific Committee of the European Systemic Risk Board, and you've been involved in this for many, many years. You were also visiting scholar at the Federal Reserve Bank of New York and academic advisor on the Macroprudential Research Network of the ESCB. This was back in 2013-14, when many of the foundations of macroprudential policy were actually developed in the euro area. So I think you're extremely well placed to bridge policy and academic field in this area. And on that, I would like to give the floor to you.
Thank you very much, Rainer, for the nice introductory words. And thank you, the organizers, for having me here also in this early hour of the 2 days where I am at lower risk of repeating ideas. Also, when negotiating on the contents of my words, you accepted having a sort of more technical, perhaps, in contents presentation at this hour, and I think this is also convenient. I guess that I will have some control on the slides from here. Is this the case, or shall I indicate the move of them? Okay, so if you have the full version of the program for the conference as it appears in the website, you will see that the organizers stated a number of questions. Let me try if this allows me to go on. Not sure. Oh. Sorry about that. Now it's go. It's go. No, but it's not me, I think. Click the button. Oh, I see. Thank you. Sorry. Too bad. Thank you very much. So a number of questions for motivation, and in particular, in the 2 panels that are going to follow my speech, there is this question which appears at the bottom in the list, which is what do we know about macroprudential policy so far? And in the middle of these questions, talking about macroprudential policies from the perspective of dynamic macrobanking models might look like an anticlimax, unless you really believe that those models are useful guidance for actual policy. What I'm going to do in my talk is to first motivate with a few general observations, and then, maybe abusing of your patience, I will elaborate on the motivation and evolution of my own research work on dynamic macro banking models in which I've been working at least for 10 years, and largely through these connections to co-authors at the European System of Central Banks, and in particular at the ECB. So let me start saying that I'm a believer in the value of macroprudential policy action and in the effectiveness of it. Talking about efficiency, as some of the questions in the motivation refer to, is more ambitious and is a harder judgment to say whether macroprudential policy action, the way we establish it, is actually efficient. That will require, I will say, what is going to be one of my repeated comments in this talk, some sort of a structural model where you can compare one policy to another, because efficient means there is no better way of achieving the same goal. We must be, and I think we are all, modest in the sense that in this policy field we live in a greater state of ignorance than in other fields. In monetary policy, for instance, this is always said, we have a much longer tradition of data collection and analytical frameworks for the discussion of whether we are missing or not the target and what will be the right course of action. Also for the ex post assessment of whether our measures were effective. But also in microeconomic policies, the situation is better. If we talk about health, education, or industrial policy, there the general equilibrium and feedback effects are probably of lower importance, which means that using quasi-experimental, empirical techniques such as the very common these days diff-in-diff approach can help us gauge what are the implications of a specific policy changes. Even there, if we go for structural models, say, of microeconomic behavior of the agents and their potential response to a tax or to a subsidy are easier, again, because dynamic and general equilibrium feedback effects are less potentially important. So in macroprudential policy, the situation is, in this sense, precarious, and we need to keep evolving. So it's 20 years, but probably the future will clarify many of the things we still don't know. At the risk of coming to commonplaces, I have written there a definition which is perfectly consistent with others on what macroprudential policy is about. It's all dimensions of public action directed to monitor, understand, or improve financial stability with the aim to ensure that the financial system keeps functional both in good and in bad times and without causing major externalities to the real economy, or to the broader economy. I never liked too much the distinction between real economy and financial economy, because financial is also real. This includes many perspectives, including avoiding the undue use of taxpayer money in support for a failing banking system, or preventing that too many, or perhaps fewer, but too big banks failing take the system into trouble, or having circuit breakers preventing that an episode in a particular bank or in a particular market extends to the broader economy. So actually, from this definition, what I want to insist is the idea that something like lending of last resort is, in some sense, part of macroprudential policy action. Or in other words, macroprudential policy action, the way my definition covers it, includes giving a macroprudential tone or having into account macroprudential considerations in any other policy that policymakers are aiming to control. So I will eventually come to talking about using specific tools that macroprudential authorities have under their direct control, like paradigmatically the CCYB, or in the countries where these are available, borrower-based measures. But I would like to communicate the view that my belief in the value of macroprudential perspectives goes beyond having a very active management of those specific tools. It goes to actually having macroprudential considerations transpiring all sorts of public policy action, from communication to monitoring, to how to design microprudential regulations and supervisory systems that do not create macroprudential trouble. I think before the global financial crisis, micropru was essentially about preventing individual banks going bankrupt, maybe not caring about what we do to prevent one bank going bankrupt is creating a stretch in the credit market at the wrong time in the business cycle, therefore maybe fitting into the credit cycle in some particular manner. For instance, I had work preceding the global financial crisis with Rafael Repullo talking about the potential procyclicality of the internal ratings-based approach of the Basel II, where say, cyclical behavior of PDs and LGDs could be feeding the credit cycle in their own way. In any case, let's then move more concrete. And in the interest of time, I'm going to elaborate mainly on capital-based tools in the banking system, but acknowledging that specific macroprudential tools include many other, and maybe should include many other. There is this still open challenge of how to extrapolate the capacity to act macroprudentially to sectors beyond the banking sector. Now, the idea, and in particular, I'm going to focus on the CCYB for the rest of my talk. Now, the idea behind this is very attractive. The idea is that we can have a higher requirement of a buffer by authorities in good times, in the view of having the capacity to better resist shocks when they come, presumably, at bad times, so that those shocks in bad times can be accommodated without creating a credit crunch, or without, that would be more extreme, taking banks down. Now, complementarily, though I always say that this second part of countercyclical buffers is less clear, we might hope for asking higher requirements in booms having an effect on smoothing credit growth in the boom and softening credit contraction in the bust. But this is to be proven. I think that the mechanical effect of buffers as loss absorbing liabilities is clear, and how to play with them is clear. Whether they actually help you cool down a hot credit growth phase is less clear. Reality, in any case, is more complicated than the pure motivation of a countercyclical capital buffer. I think we have all heard, especially in the days immediately post the COVID-19 experience, frustration about the lack of use of presumably usable buffers. So authorities reacted to COVID in the case where they had activated CCYBs by releasing them. Or in the case of not having CCYBs, sometimes by declaring that they will see with no major trouble banks possibly eating on some of the other existing buffers. But this didn't happen, and there has been a discussion of why this didn't happen. What banks do is not mechanically stick to the requirements that we impose on them. They have voluntary buffers on top of minimal requirements, what is called management buffers, and they manage those presumably on the basis of sophisticated dynamic internal management considerations, which include market pressure, concerns about which signaling effects will have eating on my buffer when others are maybe not eating their buffers, or having this or that payout policy accompanying them, concerns if they are global players of how would I be competing with others that are not subject to the same releases, fear maybe of not violating the requirements now that the buffers have been released, but then being in trouble to rebuild the buffers if the crisis is too temporary, and authorities whose behavior is not driven by strict rules, leading them to push the buffers up too early or too quickly, and then creating me trouble during the recovery phase. Now, this picture is further complicated if we add dynamic general equilibrium considerations. And in one paper, which I think I've cited in one of these slides, with David Martinez Miera, actually at the very beginning of this research program, we found that in a context where banks were endogenously choosing how much to gamble against systemic shocks, we discovered the importance of what we call, at least in the revised version of the paper, the scarce equity or net worth preservation effect. A bank doesn't want to gamble its capital in good times if capital is a very precious resource to have at bad times. Now, if macroprudential authorities include counter-cyclical measures that are going to avoid the scarcity of capital in bad times to be too high, they are actually diminishing banks' own incentives to guarantee that they can preserve their lending capacity in bad times. In some sense, authorities will take care of smoothing my capital needs in the past, so why should I then act prudently to preserve my capital in the past? Of course, there is still the credit supply smoothing effect, so the welfare assessment is at the end a complicated issue, and in the context of that model, which was a dynamic macro model with banks, we saw that if capital requirements, minimal requirements are high enough, then playing a little bit around with counter-cyclicality is welfare improving. But if the benchmark capital requirements are too low, then it's counterproductive. You put the system too much at risk when you decide to release buffers on not so much abundant capital during the bust. In the last sort of calibration of that model, we find that the benchmark levels should be 15% capital to risk-weighted assets and a buffer of about 2.5 percentage points, like very much in the Basel construction, if we interpret it generously. I think I need to accelerate, but when we started basically in around 2010 to speak about adding banks in dynamic macroeconomic models with the intention to be able to talk to those in charge of reforming capital regulation, we thought it was essential to move beyond what macro was delivering at the moment. At that moment, very few models and published papers in macroeconomics had banks. You have a few there, all published in 2010. Actually, a lot of the work, and there was, of course, already work, including financial frictions in macroeconomics, was adopting a combination of what I call shortcuts and tricks. But don't take it derogatively. I mean, all macro and maybe all economic modeling is about the right shortcuts and the right tricks. But quite a common shortcut was to have models with financial frictions in which households with lending capacity were directly lending to either households or firms with borrowing needs, abstracting from intermediation, abstracting from banks. Then there were models of a second generation, I will say, that they were adding banks, But then to simplify the balance sheet of the banks were directly holding physical capital. So they were directly in charge of the investment function that in a typical macro model is played by firms. So the banks were attracting funds from depositors and their owners and channeling them directly to physical capital, thus not representing the nature of bank assets, which are risky loans to a large extent, at least under the most stylized representation. Then even when considering banks making loans, sometimes the simplifying assumption is that either the borrowers or the banks never go bankrupt. At least they don't go bankrupt in equilibrium. So although there are very interesting insights from the macro literature on the type of topics that we care in macroprudential policy, with the models received as endowment when all these paradigm shifts arrive, we didn't have maybe the right tools, at least not the right tools to tell our policymakers whether a 15% is better than a 10% or whether a counter-cyclical capital buffer is going to help or not help. So with my co-authors, and feeding on micro papers of reference that appear in that slide, we put the effort to develop macroeconomic models in which banks and their borrowers could default. And this is at the origin of the first paper in a sequence that some of you may know, which is being popularly known as the 3D. I will call it the 3D saga in the rest of my talk, with a large number of co-authors, and that was in the context of the Macroprudential Research Network of the European System of Central Bank. We produce a model whose basic structure can be seen in this complicated picture, where banks were at the center of the financial system, channeling funds from their owners in the form of equity and from depositors or other investors in the form of possibly defaultable debt to borrowers, in the case of the model, both firm borrowers and household borrowers. And the banks, the borrowers of both types, could default and produce losses and spread losses across the system. In this system, the net worth provided by the owners of the firms, the owners of the banks, and as residual net worth owners of the houses that they own, also the borrowing households. This net worth was evolving over time and was producing a transmission of shocks, very much like in the financial accelerator tradition. So one way to summarize what we were doing there is to bring the banks and the defaultable debts of banks and their borrowers into financial accelerator type model. I will not, I think, have time to go through the various sequences in that research program. I think the program was showing productivity in terms of being able to produce, like what you see here. This is from the very first Clerk et al. International Journal of Central Banking paper, impulse response functions over a variety of variables to a shock that produces losses, asset losses to the banks. And consistently and within the logic of the model, which is the beauty of the structural models, we could compute what are, in this case, for the steady state values in the non-stochastic equilibrium, the effects of raising the capital requirement on a number of variables. So in the first try, we already had a setup where we could claim this is what the model tells us is the optimal level of the capital requirements. In continued work with several of my co-authors in the first paper and some new added co-authors, we did a number of further things. So in this Journal of Money, Credit, and Banking paper, we were digging deeper into the nature of capital requirements in the Basel setup, at least under the internal ratings-based approach. The requirements are increasing in the probability of default of the borrowers. In a structural model, the probability of default of the borrowers is endogenous to your capital requirements choice, something which is very hard to gauge in, say, a stress test approach or in a pure reduced form empirical approach. Through the eyes of the model, we could simulate what were the effects of increasing capital requirements on endogenous PDs, which were feeding into the Basel-type formula for the capital requirements. So in that setup, we could discuss things like what is the optimal profile of capital requirements as a function of the PDs in the horizontal axis, and also in the richness of the model, either from the perspective of the borrowing households or from the perspective of the lending households. So in the spirit of heterogeneous agents models, not all agents in the economy get equally benefited on the net from having better or worse prudential policies. So there, I think the black curved lines are the curves of the Basel Agreement, and the other lines tell, through the eyes of the model, how the level of capital and the dependence on PDs should look like. So it happens that both borrowers and lenders, in the case of mortgage loans, will agree on having more capital charges than Basel, but less dependent on the PDs. I think this is quite informative. In the case of corporate loans, actually very much the same story, but at different levels. Well, I think I need to wrap up. This sequence had a number of extra steps to publicize. So in another one, we were adding monetary frictions. As you see, we were very, very slow. We also faced the following problem. This is almost a confession. When sending our papers to macro journals, they were saying, send it to a finance journal. And when sending our papers to a finance journal, they were saying, send them to a macro journal. So in the end, we started very modestly in terms of publication. And we were growing up. So I think this piece ended in the Journal of Monetary Economics. And the last in the sequence, it has also some interesting implications that I will have no time to discuss. But in the same spirit that structural models are valuable in assessing policies that have not yet been enacted, or comparing alternative policies to the ones that have been enacted. So the last in the sequence actually is with Juan Rubio as added co-author, and is under review in a top journal. We'll consider further sophistication in the modeling of asset returns of banks. As part of the tricks that we were using inherited from the literature, we were assuming sort of log-normal shocks to the performance of bank asset portfolios, but that will give asset returns with distributions like the green one on the right panel. Whereas if a bank holds a portfolio of defaultable loans, the returns on loans are very different because a loan can never give you more than the principal back. Whereas the low tail, in case there are like large default rate in the economy events, the low tail can be much thicker than in the green line. So when re-estimating the models or formulating the models in that direction, we were actually finding that the capital requirements that come out as optimal when you take the nature of bank returns into account are more of around 16% instead of around 12%. So I think this is just going into detail, but if we need to go into details, macrodynamic models are part of the strategy. We were very pleased to see, that now this type of papers go into Econometrica. So coincidentally, in 2021, we have two papers very much of the kind that we were doing since 2010, going to very top journals. So I'm very enthusiastic about this research program, and just want to conclude saying pay attention to them, encourage your economies to work on them. Of course, they are not the only tool. Of course, there is a stress testing. Of course, there are empirical strategies, very useful. We will keep learning. I hope everyone a very productive conference. Thank you very much. I think we are going to have some Q&A now, so I will stay in the podium.
Absolutely, we have some Q&A. Thank you very much, Javier. So please stay. Just one housekeeping issue. So whoever wants to ask questions should have a microphone, because we have a group of people online, and otherwise they don't hear what's going on. So Maria,
Okay, thank you very much. I'm Andreas Haridou from University of Cyprus and from the Board of Directors of the Central Bank of Cyprus. Thanks for the very interesting presentation. I really liked it. And I like the fact that you talk about optimum capital adequacy ratios, and you said, you know, approximately 15% with a buffer of 2.5%. Of course, that depends on the country. I come from Cyprus. I think Cyprus is one of the riskiest type of financial, type of systems compared to other countries. But beyond that, I would like to go back. We started with Basel Accord, as you mentioned, 1988 with 8%. We went in 2008 again with Basel II, depending on the riskiness, 8%. Right now, we're talking about 15%. What has changed in capital adequacy ratios, or optimum capital adequacy ratios are changing over time? I assume at that time they were considering, again, optimum capital adequacy ratios. Is it because right now we became more conservative? Is it because we're taking into consideration more the riskiness? What has changed and capital adequacy ratios are changing over time, are going up? Thank you.
Do you want me to take this question now? Okay. Well, if not, I will answer this one. Thank you very much. Well, it's always challenging to assimilate the capital ratios that our policymakers put in place with optimal capital ratios. A benevolent dictator will definitely have incentives to set the optimal capital ratio, if knowing what the optimal capital ratio is. So I will argue that from a macroprudential perspective, maybe the capital ratios of the first and second Basel Agreement were considered okay. But I think the diagnosis during the global financial crisis is we have missed the systemic risk implications, we have missed the procyclicality issue, we have missed the systemic banks issue, we have possibly missed issues that I have not talked about, like about the quality of capital, right? So I don't see necessarily Basel III as fundamentals of the economy have changed, but our understanding of the fundamentals of the economy, which include how systemic risk builds up and produces externalities across the system, has changed. No? So then we have arrived to the 15% if we start adding buffers. If we start adding the capital conservation buffer, the OSIS buffer, the global systemic institutions buffer, and if maybe some activated systemic risk buffers, and something else. No. Is the world nowadays riskier? Probably yes, but I will need, as a researcher in the field, I will need to go to the data and check, not to calibrate by sub-periods and see whether there are indicators telling us volatilities are higher, say, in the last 20 or 30 years than in the previous historical periods. But let me maybe take the opportunity to say that in this area of macro-pru, we are playing with low-frequency events, very low-frequency events. So it's tempting to say, oh, the world became riskier after 2000, let's say, 6 or 7. Yes, of course, because the global financial crisis is like widening the volatilities of lots of macro indicators afterwards. But this is not because that risk was not latently there, maybe for 20 or more years earlier, no? So this is a big challenge for researchers. Now, on your Cyprus perspective, yes, the numbers I've mentioned refer to models calibrated to match means and variances of macro and financial variables for the euro area as a whole. And with other co-authors, we have now a model calibrated for the US economy, and the answer of the 15% plus 2.5 counter-cyclical is more or less the same. But I fully acknowledge that if you do it for Cyprus, probably if I were doing it for Spain, the answer would be similar. Maybe we need a little bit of extra to account for specific features, openness, external dependence, etc., etc. You are the authority for this, yes.
I can understand where you come from an academic perspective, and then using the term optimize and all those nice things. But keep in mind that in real life, the work of the Basel Committee is trying to come to a compromise such that everybody can do it, regardless of whether it's optimization or not. And the basic thing that happened during the global financial crisis is that it became obvious that risk weights were way, and the capital needed to go up one way or the other. Now, when it comes to Basel III, there's a sort of a myriad of technicalities, and there's no optimization in that. So basically, you say, okay, capital needs to go up. Now, can we get to a compromise? Do it whichever way you want, as long as capital goes up. And then, of course, that most academics would find extremely illogical and stressful. That's how these things happen, but that's what happens in the real world. But also what was really, really important when this happened, and these conversations took place, was that it was pretty obvious, I would argue, that if you look at the risk weights that were in place earlier, they were just way too low because banks could calculate the risk weights themselves, which is equivalent to saying that you can correct the wrong exam. And that needed to be changed. And for that reason, it actually took several years of arguing back and forth that we ended up with the risk weight floor, so that the internal risk weights cannot be lower than 72.5% of the sort of more mechanical models that supervisors use. And what that, of course, implies, if you negotiate something which is expected to apply to the whole world, then various individual countries will clearly be off. But that's not the point. The point is that it's better to have more capital compared to having less capital. And this is where it also gets very complicated when it comes to the countercyclical capital buffer, because, I mean, your point from an academic perspective is to say, okay, let's try to calculate the optimal countercyclical capital buffer. But a completely different way of looking at it is to say the following, which sounds cynical. The only way to get to a compromise, if you want to put in place a countercyclical capital buffer, is to do it in such a way that the technicians are happy because we haven't had it before, and then the banks will be happy if they realize that it doesn't really matter. And then you end up with a fairly low countercyclical capital buffer. And that's kind of a practitioner's reflection on what happens in the real world. But that does not mean that one shouldn't stop doing this type of calculations that we do. They're very, very important, and it will take some time actually to sort of move these things gradually forward, because regardless of what the bankers say, eventually there will be a Basel IV and a Basel V, and then this is going to be what you do can improve those.
Thank you very much, Stefan. I think we are perfectly aligned on the perspectives of what academic research or research also at policymaking institutions can deliver in this context. Let me tell in academic terms what you told us is about the political economy of bank regulation is very difficult. So under the political economy view, those capital requirements that emerge, especially from international agreements, or especially from authorities that are not completely politically independent, are likely to be lower bounds to what an optimal requirement might be. But I think, yeah, academics and research in some sense also have this function of acting as the voice of your consciousness, right? Like saying, okay, maybe it's not enough. Maybe you are, when doing all these dealings just to get the U.S. in or to get the emerging countries in, you do some dealings. We also do dealings in the climate policy area. So you are sacrificing something, right? Also for what I will call some Talibans in the profession that will say, oh, the solution will be like to impose a super high requirement for everyone, and that's it. Well, it's very easy to say, but if other countries don't follow your very ambitious policy, what you will be doing is killing your banks in the favor of other international banks. So the political economy is to be played, of course, in conjunction with the research contribution.
Hello, Gediminas Šimkus, Bank of Lithuania. I have a question kind of similar to what Stefan has asked. Because we kind of use capital adequacy and capital as synonyms, but they are not. Capital adequacy is a ratio of numerator-denominator. And here we do have, with the involvement of the Basel requirements, lower risk weight and like a lower denominator. Question what's happening with capital. And this leads me to thinking, if I have a bank, let's say I take the modern bank from nowadays and I put it back in, let's say, in year 2000, would it have? Having the same level of risks, no matter how you estimate it practically or academically, risk-weighted assets, would it have more or less capital? And vice versa. If I take any of the bank from 2000 and like put it forward to nowadays, would it have, having the same risk, more capital or less capital? And what you mentioned, most likely today's world is more risky. That's what you have said. And I move further. So what about the leverage ratio? So we discussed here capital adequacy, this and there, but there is leverage ratio stepping in, and this is more about capital, not the capital adequacy as such, at least because it's measured by the assets. So how this interplays capital adequacy, and leverage ratio in this new macroprudential framework?
Yeah. Well, I will be then talking without being informed by explicit models, because I haven't worked on that, and maybe I should know some reference in the literature to be more authoritative on this. I think I buy the story that the leverage ratio is essentially a backup, which will help guaranteeing that banks that want to play too much around the internal risk weights can at least have that amount of capital per non-weighted assets. But it's still a ratio. So, maybe to the level of abstraction of some of the models that I have mentioned, the analysis will not look very different. We will have to pay attention to the calibration. And my feeling is that as we actually, I think, see in quantitative impact studies, the leverage ratio requirement is like a second requirement that is likely to be binding for some banks with very low risk weight density. But the one that I think still drives credit decisions, distribution decisions, is the risk-weighted standard adequacy ratio. In several fora, if you make me choose unconditionally on one or the other, I go for risk-weighted. So I fully understand Stefan's concern on the danger of banks playing around with risk weights in, say, opportunistic, self-interested manner. So the floors are a good idea. But I don't think all assets are equal, and going for removing the capital ratio and just a leverage ratio will probably mistreat the safest assets or impose too high a burden on them, meaning that probably they will go away from the balance sheets of the banks. They will go to the non-banks, no? Because to guarantee the safety of banks holding the riskier assets, you will have to impose these high ratios also on not so risky assets that then will flow to the non-banking sector, creating trouble potentially out of what our regulatory tools are more able to cope with. But this is very preliminary thinking. I think you are telling me in terms of research program, we should have a model with the two ratios. And actually then I will connect with the tradition of Enrique Mendoza, who's coming in the next panel, because depending on shocks and possibly heterogeneity across the system, one of the two will be binding, but the two not at the same time. So we'll be like in a wall of switching occasionally binding constraints, which technically is very complicated by itself.
Okay, any other questions? Yes.
Thank you for your presentation. Very nice numbers and very interesting views. Essentially, the capital adequacy ratios are from the point of view of the commercial banks dead money, money that are being freezed, not being put in the business. And as we understand the need for safety, if you put 15% capital adequacy ratio and start topping up with buffers, is it possible for regulators to develop a dynamic model that would kind of squeeze or expand on the top of the basic capital minimum capital adequacy requirements, those buffer ratios to enable kind of like cyclically changing macro environment? I don't know if you get what I'm trying to ask.
Well, maybe for the last part, I was a bit lost in the sense that are you telling me, are we able to develop the model that could inform about how that type of regulation will work? I would say yes, this is a type of models that we can.
A dynamic model that would say fix the 15% minimum requirements.
And optimize on the buffers, maybe?
And optimize
sure,
on the buffers,
this is what these structural models help you do. I mean, for instance, in one of the papers under revision, we actually simultaneously optimize on the level and on the sensitivity of the ADAP, of the countercyclical ADAP, to deviations of maybe following reality credit from a steady state credit. But it could be GDP from steady state GDP or GDP growth. So I think technically, yes, this is the type of thing that the models I have referred to can help us analyze. But let me clarify one issue in your question. You were saying that asking for capital is asking for money to remain non-productive. I disagree. I mean, that would be more a liquidity ratio. No? In a liquidity ratio, you are telling the banks, out of your assets, keep your assets in safe and liquid form, which for a bank involved in maturity transformation is like saying, keep your assets unproductive. Keep your assets in the current account of the central bank. Now, in the case of capital, and this is actually a very long and deep debate in academia, and Martin Helwig, I don't know whether he will be hearing us, but I'm sure he will make this point in his remarks. Equity is a funding source. So what we are asking banks is to commit their owners' wealth in the funding of the bank, together with depositors' wealth. So equity required to banks is productive because it goes to support the asset activity of the bank. So actually here a very theoretical thing comes to mind is Modigliani-Miller's theorem. Will tell every academically trained economist that under ideal condition, capital structure does not matter. So if you start with that benchmark and then you add the twist that but when banks go bankrupt, they generate negative externalities, you will quickly arrive to the conclusion that, well, if in the absence of those externalities, capital structure does not matter, once you tell me banks failing is a problem, we should go for as high as possible capital requirements. But then something goes wrong. Something goes wrong. We don't think banks will be able to operate with 100% capital requirement. And then there is this tension between, you know, the idealistic view that very high capital requirements is the panacea, to having models with their frictions properly quantified to tell you how much is enough and convenient from a social standpoint. Thank you very much. I think it's time now for moving forward.
Yeah, thank you very much, Javier,
thank you, everyone.
This wonderful lecture and for the discussion. I think you kicked off the academic part of the conference in a very, very nice way. We don't have a break. That's the bad news. The good news is we're having a very nice panel now, also on the more academic side, and that will be chaired by Thorsten Beck. So please take your seats. Thank you.
Okay. Sorry. Oh, yes, it does work. Wonderful. Thank you very much. And thank you again, Javier, for kind of setting the tone for this discussion. And I think some of the topics will come up again. I think this panel, it's called, what do we know about macroprudential policy so far? In parentheses, academic. Now, I think and actually as Javier already kind of illustrates himself, the borders between, the boundaries between academia and policy are always a little bit, or policy world, if I may say so, institutional world, always a little bit fuzzy nowadays. I mean, we have Ricardo over here who works in a central bank. Javier and I, as mentioned earlier, we're both at the Advisory Scientific Committee at the ESRB. So I think it's maybe more the kind of the way we approach the problems, and we've seen already a little bit here between the dialogue between Stefan and Javier on that, which will be more the focus of, which kind of makes a difference between when it says academic or policy in the parentheses after the respective session. So I'm not here to talk, I'm here to chair. So we have three excellent panelists. Two are sitting next to me. The third one is online. Can I just check? Martin, can you hear us? Okay, that's not starting well.
Yes. No.
Well,
and see everything.
Oh, wonderful. Thank you very much. So, and Martin, of course, has been already mentioned, but just to kind of do the formalities here, right next to me, Enrico Mendoza, who will start University of Pennsylvania. To my very right, Ricardo Correa, already mentioned Federal Reserve Board. And then remote, as already alluded to, Martin Hellwig from Bonn, MPI, Bonn, Professor Emeritus. So we're going according to the order of the program, just to make things easy. We're going to start with Enrique. I ask every panelist to kind of try to keep it to 15 minutes so we have enough time for discussion and also for Q&A. Enrique, please, over to you.
Yes. Need my slides. I'm going to stand over here for a second. Thank you very much. So I'll wait for this to be loaded before I can get started. I prepared some remarks lined up with the questions that we were assigned. So it's exactly about what do we know about macroprudential policy so far. So let me start with what we know empirically. And this is not my area of research, but I tried to collect for you what I think some of the empirical literature on the implications and the effects of macroprudential policy says. Well, the starting point is a rather empirical one. Is the observation that credit booms tend to precede financial crisis and hence should be prevented. That for now is a conventional, very well accepted empirical wisdom. There are tons of empirical research on this issue from the financial cycle, from the classic work by Claudio Borio, who was one of the pioneers in this side of research, and some of the work I did with Marco Terrones and the work by Hilary Taylor and Carmen Reinhardt and several others. So this is a well accepted fact. You can come at it at the reasons for macroprudential policy coming from a theoretical standpoint, but it really does come from a very practitioner's point of view, which started in emerging markets in the 1990s and then followed through in advanced economies with the global financial crisis. So that's a well-established fact. Now I'm going to show you in a minute the results on the empirical literature about the effectiveness of broad-based or aggregated measures of macroprudential policy. You could say they're mixed at best. So the measures of these broad MPP indicators, when it comes to aggregate credit, when it comes to aggregate variables like home prices, are very mixed. And this comes from two survey work by Galati and Messner, as well as the work by Gambacorta and Murcia. And more recently, from this work by Juliana Araujo and co-authors at the IMF, it's actually very, very nice. It's analysis of 58 papers, which includes about 6,000 estimates. And what you get from it is the precision-weighted standardized average effect of combined aggregate macroprudential policy tools on credit. It's only about minus 0.8%. And not only that, it is a very noisy thing. So let me try to show you in this picture and then see if I can manage to come back. So there is the idea. I don't know how much of this you can see with the chair sitting up here. But essentially what you see here is if you took the precision-weighted average, which means adjusted for the variability of the different estimates, and what you see in each of these gray lines is the estimates under a 95% confidence interval. So what the red line is telling you is what I was just mentioning a minute ago. It's about minus 0.8%. So you can think of this as about an elasticity measure, or the impact that changing the aggregate measures of macroprudential policy have on aggregate credit. And what's also somewhat surprising is how noisy this is. So the negative effect, which is what you would like, that tightening the policy will shrink credit, is driven by the results that you see down here. But the majority of these ones, you cannot rule out at the 95% confidence interval that they actually zero. So the news are mixed when you look at these aggregate measures, unfortunately. And if you start controlling for things, it gets worse. Controlling for the 0 to 6,000 estimates that actually come from unpublished papers, the effect of these broad-based measures on credit is statistically non-significant. And when you think about effects on housing markets, housing tools, again, aggregated measures of housing tools tend to be also not statistically significant, particularly if you control for what they define as tools in place. Moreover, all aggregate macroprudential policy tools have statistically non-significant effects when it comes to specifically household credit rather than aggregate credit and home prices. Now, what's very important and reflects to some degree some of the comments that Javier was making is when you actually look at a specific instruments. So you start to stop looking at the very aggregated measures and actually look at, say, for instance, loan-to-value ratios on housing. How much they affect home credit, house credit. Those effects are strong. And similarly, when you look at DTIs or capital requirements, and when you look at micro disaggregated data effects. On the other hand, the mantra of macroprudential policy was about affecting aggregate credit. So yes, this is very important for what we're after with these mechanisms, but this is still, I think, some not so good news. So that's what I think we know empirically. What we know theoretically, well, here, just like Javier, I'm going to focus a little bit more on what I know more about, which is this research that comes out from these aggregated models that are about starting by explaining financial crisis. So first, consider from a positive question, from the different models of financial frictions that we have nowadays, which models can account for the stylized facts of the typical financial crisis. There's a collection of models about this phenomenon. I'm going to focus on the ones that I have worked with a series of co-authors that I'm very grateful for the opportunity to have worked with, particularly with Javier Bianchi. So the positive side is these models, which I will call Fisherian, which are driven by these occasionally binding financial constraints in which leverage plays a central role, have shown that the deflation of collateral prices that occurs when agents suddenly have to face the need to put up with collateral or respond to margin call, this mechanism, the margin calls, this mechanism provides a plausible mechanism, I would say, rather than an empirically tested mechanism, because we are just recently starting to work in other areas of research with the estimation of these models. What we know now comes from quantifiable calibrated models. What those models are telling us is that this class of models are a plausible mechanism for explaining financial crisis facts. The same models, if you then turn them to the normative analysis and ask the question, what's the optimal policy? And the same models, and you ask the question, is there a case for policy intervention to begin with? What turns out to be the case is that indeed in these models there is an inefficiency. There is what we call a pecuniary externality because individual borrowers do not take into account the aggregate effects of the individual borrowing decisions when they're borrowing. In particularly, for a hypothetical case, you could say a borrower buying a house in the United States in 2004 does not take into account the aggregate effect for the collapse of housing prices of 2008 of their individual borrowing decisions. As a result, they undervalue the social marginal cost of borrowing, and as a result, there is a room for the imposition of financial regulation that brings the private perceived marginal cost of borrowing in line with the social marginal cost of borrowing. Quantifiably, again, these models show that the optimal policy, if you actually ask the question, what will be the socially optimal policy that brings in line that social marginal cost with the private marginal cost, it's a very powerful policy. In the models, it reduces sharply the frequency and the magnitude of financial crisis. So that within the models lies the promise of macroprudential policy as a very effective tool for reducing the magnitude and frequency of these events. But the same models, if you look at them more carefully, is actually quite challenging. And this also reflects a very important comment that Javier brought for you, is that you look at this policy, it's actually quite complex. It's actually quite nonlinear. It lacks credibility in the sense that the optimal policy is time inconsistent. And this is a comment that Javier was also making. It's a very different world from the world of macroprudential, of monetary policy. When you look at monetary policy models, not only is that we have a much older, much more well-established tradition, is that in those models, the Taylor rule, whilst it's not the optimal policy in the theoretical sense, it's a very effective policy. It does away with most of the time inconsistency problem. And when you put it into quantifiable models, it turns out to be not that far from what the optimal policy delivers. Not that far from what the optimal policy delivers. It turns out in the world of macroprudential policy, none of this is the case. And actually, there is the risk of doing much worse than doing nothing. So here is just some quickly results from a work that Javier Bianchi and I did in the JPE a few years back. This is what, what happens if you don't do anything. So the world without policy regulation is a world where financial crises occur with 4% probability. When that happens, asset prices fall 44%, and the equity premium widens. There are substantial drop in output, substantial drop in investment, and so on. This is the world of the optimal policy. So this is what I was telling you. The optimal macroprudential policy essentially reduces the probability of crisis to 0. And when crisis events do occur, they're much more tepid events than the typical financial crisis that these models produce, which actually don't look that different from what you see in the data. And this is an exercise calibrated to advanced economies. Now, here we say, suppose that you cannot implement the optimal policy. What is an optimal policy that looks a lot like a financial Taylor rule, in which what you're doing is targeting credit. So it also looks a lot like the CCIB, by the way. You have an elasticity, which will be the equivalent of the Taylor elasticity in the context of this setup. You're targeting credit, and you also have an intercept here. So if you look for the best combination of those three parameters that brings the largest social welfare gain in this environment, and what you get is this environment, in which, as you can see, relative to the optimal policy, the effects are much more tepid. So while you are better than doing nothing, you are far from what the optimal policy is. And this is very different from what happens with monetary policy experiments. It's a measure of the extent to which we still need a lot, we still have a lot to learn for the implementation of these policies to be a more feasible thing. So what are the things we know theoretically? Well, we know also a lot, we have learned a lot about the interaction with monetary policy. We know that it's a lot better to have separate monetary policy rules and separate macroprudential policy rules than to try to lean against the wind, to try to enrich monetary policy rules with financial stability setup. That comes also from work we did a few years back, just showing how much more effective is a separate macroprudential policy rule with a separate monetary policy rule than an environment in which you introduce financial stability rationale for a standard Taylor rule. And this was done in the standard neo-Keynesian model in which we tried to put these things together. So let me say a few things in the 3 minutes that I have left. One thing that we really don't know a whole lot about is the efficiency trade-offs. Most of the studies that we have done so far in this line of research, the trade-off of you're regulated too much has to do with consumption smoothing, which is not a very relevant margin for credit. What we understand little about is the trade-off in terms of capital accumulation. So the other side of every macroprudential policy tool is that it's actually like a tax on capital. So it causes inefficiency in investment. And in particularly when you look in heterogeneous agents environments, and this is again a point Javier was making, and I want to reaffirm, is that we know little, and what we know is that they cause very severe inefficiency. They cause significant misallocation across firms. And as a result of the misallocation of factors of production, they can produce significant welfare losses. So in somewhere we have done recently, we look at the case of capital controls management, macroprudential capital controls. And they actually work like size-dependent policies. As a result, there is a segment of firms which are in the middle of their growth, which are the more productive, which are the exporting firms, which are the ones you want to prop up. And those are the firms that are more severely affected. Their capital is too small, and the misallocation of capital relative to other firms is very substantial. If you look at alternative measures relative to capital controls that address the size dependency more carefully, again, loan-to-value regulation dominates. It can achieve the same aggregate credit reduction at a much less harmful effects in misallocation of capital and social welfare. And we also produce empirical evidence from a natural experiment in the case of Chile in the 1980s, in which they went through a period in which prior to the 1990s had no capital controls. After the 1990s, they have 5 years in which they had capital controls, and beyond that, zero capital controls. So we have rich data at the level of the firms from which to look at this, and from which we obtain these results that show that this is very important. So I'm not going to go through this, because I already told you in words what happens at the firms that are at the firm level, the middle-sized firms. These are the ones that you see marked in blue. Those are the firms that you heard. What you have here is the net worth of the firm and their capital as they're growing through time. What you have is a distribution of firms. You will have a plot like this for each different firms according to their level of productivity, and this is where the misallocation comes from. So I think at the end what I have is a point about how important it is that we look closer and closer at these effects, the heterogeneity, households in the borrowing side, housing markets, but also on the firm side, the allocation of capital for emerging markets in particular, since emerging markets tend to have these bimodal distributions of firms with a lot of firms that are very small, a lot of firms that are very large, and the issue is how do we get a more even distribution of firms when financial regulation has this adverse effect that tends to prop up this bimodality in the distribution of firms. So I will leave it there. Thank you.
Well, thank you very much, Enrique. This was very insightful. I think you showed us, it's kind of actually following up on what we discussed earlier. So theoretically, we know very well what to do. But when it comes to the implementation, it's getting much trickier, and that might actually also be behind why we don't see, in the empirical analysis, we don't necessarily see the results that we would like to see, or that because the optimum policy is not being implemented, either because there's lack of information, time inconsistency, non-linearity, and so on. I think we're going to come back to the empirical literature at a later stage, but next up is Martin Helwig, which if I understand correctly, is going to be a bit more skeptical of the whole approach to macroprudential. Martin, over to you, please.
Well, thank you very much. Can you hear me?
Yes, we can.
Contrary to what Shahzad suggested, I will not talk about capital regulation and a demand for high capital requirements, except to say that in all the discussions about efficiency, I tend to miss the basic effect that funding choices of a leveraged institution are biased by debt overhang effects. That's the leverage ratchet effect we discussed in the Journal of Finance article in 2018. So next slide, please. The global financial crisis brought us systemic risk analysis, macroprudential regulation and policy, and all of that is routine. And I'm wondering whether we know what we're doing. Next slide. What do we actually mean by the term macroprudential? Is it the potpourri of measures that's listed in the legal norms in ESRB surveys? Is it what Spain did in the years after 2000? What we should have been doing in the years before 2007? What precisely was that? Sometimes I have the impression macroprudential is what national authorities want to do anyway, but that is not admitted inside the EU's harmonized rulebook. One thing we know, it's not microprudential. That's what Andrew Crockett told the supervisors when he presented the idea in 2000. And the supervisors have been repeating, it's not microprudential, so please stay out of our turf. That's an experience that the ESRB has had whenever it was asking for information. Next slide, please. We have a fair number of policies. One policy instrument that's extremely popular that should be mentioned is forbearance. We can't intervene in banks now because if so, we would prevent them from granting more loans. I submit that's also a very popular macroprudential policy, which, and in fact, it was implicit in some of what Xavier said about if the basic capital requirement is very low, then having cyclical surcharges may be problematic because the release of these surcharges in bad times may be a bad idea. Is it macro or is it micro? All of those measures are really micro and are part of the standard tools of micro supervision, well, regulation and supervision. Why are monetary and fiscal policy measures not considered under the Macropru label? How does Macropru relate to those two? This theme of relation to monetary policy came up in the two talks we've already heard, but it's something to think about, especially because it conflicts with a sort of one policy, one objective principle. So one problem is that Macropru is not really a policy of its own, but a dimension of other policies. And then another problem is that the actual implementation tends to be discretionary. Decisions depend on political economy and delays are to be expected. Next slide, please. In the German case, with worries about a real estate bubble, a countercyclical capital add-on was announced after very lengthy discussions in late 2019 to take effect in mid-2020. Given that a recession was already threatening, it seemed clear that the effect would come at the worst possible time. Then with the pandemic, it was rescinded in March 2020. But even without the pandemic, it would have been a bad idea at the time when it should have been implemented. There is a lack of political will of taking away the punch bowl where the party is going. A more positive example, the ESRB's report on foreign currency lending to individuals gave Eastern European authorities support for restricting such lending. And at least in the Polish case, I've been told that that helped to very much soften the impact of the 2015 Swiss franc revaluation. I want to go, next slide, please. I want to go to a more recent experience. From March 2020 to March 2022, when money market interest rates were practically zero, many US banks took large uninsured short-term deposits and invested in long-term securities. From March 2022 on, investors slowly moved back out of deposits and into money market instruments. The authorities failed to appreciate the significance of these developments. They do so even now. The interest rate, at least according to their public pronouncement, the interest rate risk taken on in 2022 and the effects of the interest rate increases in 2022. Effects on investors' incentives and on bank solvency. Next slide, please. The reason was that they took the accounting numbers at face value without appreciating that held to maturity classification, which allows you to not acknowledge fair value losses, might not be sustainable if depositors leave. They treated the crisis of March 23 solely as a liquidity crisis without appreciating that the run on SVB was triggered by a perception that the bank's insolvency, which had existed since September 22, would be laid open once the drain on deposits forced a sale of HTM securities. As of now, we should appreciate that the support given this spring was all for liquidity. But if the liquidity support comes at an interest rate of 5% and your 2021 investments yield 1.5%, the banks have a solvency problem. That solvency problem seems to not be on the radar screen. Next slide, please. Interest rate risk is fundamental. I'll come to the semantics of the term in a minute. The SVB crisis has parallels to the S&L crisis in the 1980s, where exactly the same mechanisms were at work. But the accounting rules and the regulation fail to take account of it if it concerns HTM assets, which applies for much of the bank book. For assets in the trading book, you can neutralize the regulatory impact of these risks by using hedges. But the hedges come with counterparty credit risk. The adjustable rate clauses on mortgages, for example, caused insolvencies in the late 1980s, and then again in the global financial crisis, or rather the subprime crisis. Next slide. There are two interpretations of the term interest rate risk. One is as a market risk for tradable securities. The other is as a macro factor that affects many risks at the same time. Risks on the availability and the costs of funding, the market value of securities, fair value of non-tradable assets, counterparty credit risk in derivatives. And this notion of thinking of macro shocks as underlying factors that rock all the parts of the boat is underrepresented in macroprudential analysis. Next slide, please. In my view, we should think of system risk as resulting from macro shocks. And there are two ways in which this can happen, and we should not exaggerate the differences between them. One is from parallel exposures to the macro shocks, the S&Ls, Sweden, Japan, Thailand, the US in 2023. The other is contagion through counterparty risks that are correlated with the underlying. And of course, some of the contagion can come about through fire sale externalities. Next slide, please. So I think the word cycle tends to be overused in this connection. And here I disagree with the previous speaker who said Macropru is all about slowing down credit booms. I think systemic risk is about more than that. And we should think about different macro factors affecting the risk exposure of the entire system. In addition to interest rate risk, of course, we do have exchange rate risks and business cycle risks. But those, well, require analyses of their own. Next slide, please. I'm skeptical, and this is in part a comment on the two talks we had so far about the usefulness of quantitative models. We should think in terms of narratives. And the reason why I'm skeptical is because if you look at developments from cycle to cycle, you end up seeing similar risk exposures in different guises. The case of adjustable rate mortgages versus outright exposure to interest rate risk is one example. So in my view, the underlying point is these guys take risks, and they take the risk where the risk premia are, and the risk premia come from macro risks. This is why they're exposed to macro risks. They must be somewhere either open or hidden. And then the question is, what devices has the industry found to hide them? Once we get down to contagion, I'm skeptical about any scope for really controlling that, for really modeling that. It's much too heterogeneous and very difficult to disentangle. We have contractual dominoes, we have problems from losing contracting opportunities. We have information contagion or hysteria contagion. We have fire sale externalities. Each one of them is complex on its own. And once you look at the interactions, the next slide gives the narrative or the story of the Lehman crisis. Next slide, please. I will not go through that, but if you just think about the complexity of events in the month of September 2008, I'm very skeptical about being able to model that. Next slide, please. In terms of assessing system risk exposure, we're talking about, and this repeats things which have been said in the previous presentations, we're talking about the multiplicity of effects in a highly nonlinear system, which probably has multiple equilibria, in which there is no transparency about the participants' positions, and the participants' positions are changing all the time, and the credit risks are endogenous. Next slide. The data series are short. The set of phenomena is non-stationary, and hidden correlations play a central role, changing all the time endogenously. Next slide. The complexity is increased if we think about the role of asset markets. How do we think about deleveraging? Something that comes about through adjusting flows, or something that comes about through selling assets? The stock flow distinction can be crucial, and different timescales may apply to different processes. This raises issues for the standard discrete time macro model, which has homogeneous periods. Corrective measures at the level of stock variables. Who's the counterparty to the deleveraging? And doesn't the deleveraging further contribute to the problem by lowering prices and lowering collateral values? I want to conclude, next slide, final slide, with the observation that even for the objectives, we don't really have a clear view. Financial stability or macro stability, they coincide on the upswing and they may be in conflict in a crisis. If the banks are weak and the economy is weak, what should be done? Prioritize financial stability and get the banks in shape again, as Greenspan did in 1990. Use forbearance to reduce the pro-cyclicality of current regulation in a depression, or beware of excessive forbearance, which may cause undue delay in cleaning the mess up. I think all of this trade-off involves dynamics. How do we weight today's problems as opposed to next year's problems? But we have little understanding of how to deal with that conflict. And on that destructive note, I want to end.
Thank you very much. Sorry, Ricardo, we have actually just. Thank you very much, Martin, for this. This was quite a forceful tour d'horizon from different crises all the way to crisis management over micro and macro pru. The 2 points I take away is number one, what is macro pru, as you said? I mean, one could argue maybe accounting standards should be considered a macroprudential policy. But then, of course, if everything is macro pru, then I guess, as you would probably argue, nothing is macro pru, and it's not really a policy in itself. And the other point that you made is about the usefulness of the quantitative models that Enrique actually was talking about earlier. So I want to give him just a few moments maybe to react to this point that he made on that.
Yeah, very quickly, just to say, not that I disagree a little with what he said. I actually agree with most of what he said. I think it is part of it is a mandate. I'll try to draw this parallel with what monetary policy has been about. It is true in most central banks, monetary policy models are not how monetary policy is decided, but monetary policy models inform the decision of monetary policy in most central banks. And it's a very well accepted framework, and it's very much in line with many countries do with the inflation targeting framework. What I try to draw is the similarity with what we're doing with financial regulation and the work towards building integrated models in which macro and finance have met. I think that has been very important in order to inform this decision-making process. The narratives are fundamental. What happens in each country and understanding the workings of financial conditions in each country, and particularly at the junctures, for instance, what Martin described with the duration risk and the hold to maturity. So all these narratives are crucial, but at the end of the day, there is part of it, for instance, take the countercyclical capital buffer, which is a mandate, which is to say, what are the thresholds at which the buffer will be activated? By how much will this buffer be increased? All of these are quantitative questions which require a quantitative answer. And what I've been trying to claim is not that we have the answer. It's not that it's the opposite, that we don't have the answer. Or we need to study more carefully the risks and the trade-offs that are embedded into getting an accurate answer for that question. Not with the hope that we will have perfect control of what the economy will do, but that economies need to stop working in silos, where we used to think that in finance that macro was an aggregate risk, so it was an aggregate shock in a disaggregated finance model, and in macro we used to work the same thing, as the way Javier was saying, where the banking sector will be some assumption, but the macro side of the model is what we will work on. And we ended up converging in these models, for instance, monetary policy models in which money does not exist, which is the framework that we have today. we need to stop working in silos and look at what others are doing. And the leveraging, and this is the last thing I would say, the leveraging is fundamental, and it is something that we have been working in these macro models for many years now. And now, on that particular aspect, we have made, indeed, a lot of progress.
Thank you very much, Enrique, for that. So we've been talking a lot about empirical results, about data, and we finally get to it because we have an expert on this. Ricardo, over to you, please.
Thank you, Thorsten. So I'm going to unpack a little bit the empirical evidence that we have so far on macroprudential policy. And when I was invited to this conference, the first thing it reminded me was another event like this one that took place in 2017 at the Central Bank of Portugal, where a new database was unveiled. This database captured prudential instrument changes for the EU going back to 1995. So I went back to my remarks and I checked what we were talking back then. And one of the things that we were talking back then is that we needed better data and better empirical evidence to assess the effectiveness of these macroprudential policies. And just on the way here, I was reviewing a few papers for a conference, and I read 4 new papers on macroprudential policies, which give me hope that we can perhaps understand a bit better what the impact and effectiveness of these macroprudential policies are on different aspects of the economy. So before I start, of course, I work for a central bank, so I have to give you the standard remarks. These are my views, and they don't represent the views of my colleagues or the institution I represent. So first, let me give you an overview or a framework or a narrow framework that people have used to think about macroprudential policy in some of the empirical studies. First, there's an objective. A policymaker sets an objective, which is to either enhance the resilience of the financial system or try to prevent crisis, so limit financial stability events that may have material consequences for the macroeconomy. And then there are some intermediate objectives. So the intermediate objectives are, as were discussed earlier, is to curtail the rapid increase of financial vulnerabilities, such as credit growth or valuation pressures, and as Martin was mentioning, try to limit systemic risk. And this systemic risk could be this interconnection between entities that participate in the financial system that could prevent some type of contagion in a stress event. Now, there are many instruments out there. A lot of the instruments have been borrowed from the macroprudential set of instruments that we've had for many years. There are some instruments that I consider that are used on a cyclical matter, and some of them, or the new ones, are, for example, the countercyclical capital buffer. LTV caps are older, but now they're being used for macroprudential purposes. And then there are the structural ones. So on the new side is the GSIB surcharges, the GSIB buffers, and then we have resolution rules that have been revamped to try to prevent that type of contagion in periods of stress. So those are more structural because they don't change over the cycle. They're there, and they're sort of in there to prevent particular amplification mechanisms in periods of stress. So this is like the framework that people have used to do their empirical studies. And the questions that they have asked, as Enrico was mentioning, is, for example, what's the effect of the usage of some of these policies on some of the financial variables or these intermediate objectives, such as credit growth, housing prices, so on and so forth. Then there's a second set of questions, which is, okay, we see that these policies have been introduced, they have been used, but we were also seeing some leakages. So are there leakages, significant leakages, when these policies have been used that prevent the policymaker from achieving its intermediate objectives? And lastly, once we hit that period of stress, have these policies enhance the resiliency of the financial system? So can banks continue lending even in periods of stress? So these are like the major 3 questions that the literature has addressed so far. Now there is a a continuum of studies out there that try to analyze from different perspectives. So a lot of the evidence that Enrique was discussing earlier are classified in this spectrum. So there are studies that focus at analyzing what's the impact of some of these policies across different countries using large databases. So the state-of-the-art database is this database by the IMF called the IMAP database, which has a prudential instrument changes for many countries across a long time series. Then there are, on the other side of the spectrum, there are studies that are focused on a particular country at a particular point in time and try to assess whether a particular policy has been effective. They're very good at identifying those relationships because you can use microdata and everything can be neatly identified. However, the problem is we don't have external validity. This policy in Spain may have done well in the mid-2000s, but does it apply to Slovakia right now? Does it apply to Finland or to other countries in different settings? So what we tried to do in the International Banking Research Network, which is a collection of researchers from central banks across different countries, is to try to do replication studies. So we think about a question, and in this case, for example, the use of prudential instruments, and try to see whether we can find similar consistent evidence across countries. And so this is a study that we did in 2017. So we tried to assess whether those prudential policies had an effect on particular macro financial aggregates and whether there were leakages. This type of methodology has been replicated in other settings. Here in Europe, for example, there are some studies on replicating the use of policies across different countries and what are the impacts. In Latin America, as Enrique mentioned, Leonardo Gamma-Corten and Andres Murcia conducted a study across different Latin American countries using credit registry data, well-identified studies, and tried to see whether the evidence was consistent across the different jurisdictions. However, as I share Javier's struggle with the publication process, a lot of journals don't like replication studies, so it's very difficult to put that evidence out, although Thorsten here has been a great supporter of this type of work, so we're grateful to him. So let me dig a little bit further into why we have this, perhaps why we have all of this inconsistent evidence, as Enrique was mentioning earlier. And part of it is coming because it's very difficult to measure what we call macroprudential instruments in their changes. And it's difficult for many reasons, and I'm going to pose three issues here that are relevant. So first, what's a macroprudential instrument? I mean, we've talked a lot about the CCYB, but in some of the databases and in some of the academic studies that we cite, a lot of the instruments that are being used are macroprudential in nature. And when they were used, say, early in the sample periods in the mid-1990s, they were not used for macroprudential purposes because macroprudential objectives were not set strictly back then. So a lot of these studies are trying to look back at evidence using some of the instruments we had, but it's unclear whether they were used for these macroprudential purposes. So that's one problem. The second problem is consistency across countries. So if a country sets up an LTV cap for particular apartments of a given price, how do you compare that to another country that sets up an LTV cap for houses of a certain price? How do you compare these two policies at a given point in time and across time? So that's another peril that these databases face when they try to collect this information. What we have tried to do in this space is to try to just map this into indicator variables. One is if it's a tightening of the policy, -1 if it's a loosening, and 0 if there's no change. But this is not a science. This is just a subjective coding of some of these measures. So this may be influencing the results that we get. And then when should these policies affect prices and quantities? Is it at the announcement date or when they are implemented? Bear in mind that some of these policies, it takes a lot of time to phase them in. So, for example, the CCYB takes a year. You have to announce them a year in advance, and then it's implemented a year after. For the other policies like LTV caps, you announce them at a particular point in time, and then you say, over the next 3 years, we're going to increase them in this way. So when do you measure this? Is it right now? Is it in next year, in 2 years? So that's another problem that we have when we're measuring the impact of macroprudential or the effectiveness of macroprudential policies. So this is like a taxonomy of the databases that are out there. I classified them in this way. So you have the IMF branch. In the IMF branch, you start with this LIM database in the early 2000s, in the early 2010s. Then the IMF has improved these databases over time, and we end up with that IMAP database that I referenced earlier. This is the database that the EU introduced in 2017, the MAPED database, which is a fantastic database, and it captured the change in different instruments between 1995 and 2014. And this has been updated on a yearly basis by the ESRB's macroprudential database. And then you have the BIS branch, which has been focused mostly on housing measures, but they have also covered other measures. Here, this is our database, where we focus on a narrower set of instruments to try to conduct replication studies on an international banking setting. But this is probably the best data that we have out there, and this is where most of the evidence is coming from when we look at the empirical studies that are that analyze cross-country effectiveness of macroprudential policies. So this is just putting something in a picture that uses our IBR and prudential database. So these are two pictures. On the left-hand side, you have advanced economies. On the right-hand side, you have emerging markets. The black line is real price changes, residential property price changes. Green bars means that the counts of countries that are tightening LTV caps. Yellow bars, the count of countries that are loosening LTV caps at a given point in time. And the gray shaded area is COVID. So what you can see is several things that probably explain what Enrico was mentioning earlier, that there's a lot of noise out there. On the advanced economy side, you do see some correlation between house prices, residential real estate prices, and LTV caps, especially after the GFC. Before that, there's little usage of LTV caps. After a lot of the usage of LTV caps has come after the GFC. There's very little correlation for emerging markets. So you have evidence for some countries, not for others. And for different periods of time, you can find different things. Now, in general, I mean, there's some, at least in the best studies, there's some correlation between the usage of these policies and prices and some quantities, especially if you look at borrower-based measures. But there's a lot of heterogeneity. There's a lot of noise, as Enrico was mentioning. And on the international front, which is also something that interests me, there's some evidence that some of these measures have helped some countries to reduce vulnerabilities related to foreign exchange borrowing for some countries. And here, I'm giving you a couple of extra charts. One that shows, for example, the broad dollar in black, so higher levels mean appreciation of the dollars, which is typically associated with tightening of financial conditions. And here, this is just the count on net of tightening of prudential policies across countries. So you see that when the dollar appreciates, there's a loosening of these prudential measures. When the dollar depreciates, there's a tightening. So countries are trying to use policies to try to prevent the effect of this global financial cycle on their economy. Here, I have a graph for EMEs where we have capital inflows and tightening and loosening of reserve requirements in foreign currency, and you do see a loose association between the two. Which leads me to my second point, which is there are leakages. And there are leakages in two ways. One, leakages between banks and non-banks, so activities move from the banking sector to the non-bank sector. And second, there are leakages depending on your jurisdiction. So if you have control over your domestic banks but not over your foreign banks, there could be leakages from activities conducted by the domestic banks to the foreign banks in your jurisdiction. So that's why there are reciprocity agreements. So I'm going to move a bit quicker. So the third set of evidence is on resilience. So there's some evidence from the pandemic that shows that banks with buffers, especially CCYB buffers, were able to that were loosened, were able to lend more in the pandemic. However, other types of buffers, like capital conservation buffers, were not as effective. Which leads me to the next last slide, which is we've been focusing on this part of the framework, but we have talked very little about macroprudential governance and financial stability communications. So these are areas that in the monetary policy literature have evolved quite a bit, but are quite relevant for analyzing the effectiveness of macroprudential policies as well. So I'm just going to leave some questions out there. For example, on the governance framework, we have different governance frameworks, including committees. So are those committees effective? Should they have power to manage macroprudential policies or not? What power should they have? How do macroprudential instruments interact with other policies, monetary policy, fiscal policy, other policies that are relevant? What do we do about leakages? Leakages to the non-bank financial sector, for example. Should we have new instruments? Leakages between the institutions you supervise and the institutions that are supervised by others. What type of arrangements do we need in that front? And lastly, cost-benefit analysis of macroprudential policies. What are the real consequences, the real set consequences of the macroprudential policies? What are the distributional consequences as well? They may impact different segments of the population. And political economy considerations, as Martin was mentioning earlier. So I'm going to leave it there. Thank you.
Thank you. Thank you very much, Ricardo, for this overview of what has been done. And I'm supposed to talk tomorrow about the research going forward. So thank you for the input. So this was also, just to put it again in contrast, what actually we heard earlier from both Enrique and Martin. So you pointed to the problem that we have in considering the impact of macro-pru, and there are many of them. But for example, you pointed to the anticipation effects, announcement versus implementation, for example. How do we actually measure? And therefore, what I want to ask Enrique now, you kind of made the point earlier in response to Martin that, so for monetary policy, there are all of these models that are being used as input for the monetary policy monetary policy decisions, and we want to do something similar for macro-pru. But isn't that what Ricardo just pointed out? Isn't that, again, a kind of a hurdle to overcome? That we just don't have the same, empirically speaking, we don't have the same kind of immediate link between macro-pru and then the impact that we can observe. So all of these different hurdles that Ricardo mentioned, including also, of course, the leakages. So that's kind of on the negative side. Does it actually prevent you, Javier, and so on, from using, putting this into the quantitative models, on the one hand. On the other hand, on a positive note, can the quantitative methods, in your spirit of bridging the gap between macro and finance, can these empirical results from the finance actually inform also your quantitative models?
Yeah. So very quickly, the answer to the two questions in one group is yes. The idea is precisely that. What works in one country and what works in another country sometimes is permeated by the structure of their own financial systems. On the other hand, there are results that are generic, and there are intersections that seem to be growing. So what Ricardo was saying, what I was showing you in terms of, for instance, the coincidence that instruments that are closer to the ground in the sense of avoiding the arbitrage of regulation that occurs as you go upstream in the financial intermediation system as opposed to downstream, specifically when it comes to loan-to-value ratios in housing. The evidence from almost everywhere that is collected shows that those are very effective. Similarly, the effectiveness of instruments that go upstream in the financial intermediation system tends to be generically that is mixed. So the suggestion from that is that we do want to use instruments that if we want effectiveness, we should worry about the kind of instruments that we use. In terms of how we incorporate them into the models, that still remains why the last bullet that I had in what I was talking about is about incorporating the work in additional quantitative models. We know about these deleveraging models. They're very stylized yet, so that's the other thing is we need to build richness into the heterogeneity to address questions like the one about the distributional impact, which I think is fundamental and is what I was trying to hint at the end. In many of the countries where the practice is now that we have these countercyclical instruments, that we use these countercyclical instruments, the issue is many of them are emerging markets. And the impact across the distribution of firms, the impact across the distribution of households is very heterogeneous, and it's something that we're just beginning to touch the tip of the iceberg.
Thank you, Enrique. Martin, I also want to give you the chance to react a little bit, and maybe my question would be, has Ricardo's presentation actually kind of alleviated a little bit your concern on Macropru? I mean, there are some instances where this can actually be useful. Of course, the question again being, how do we classify these different policies?
Let me be very clear. I don't think that the research that has been presented or sketched is useless. We learned something from this. And Xavier's lecture this morning made this very clear. However, we need to be more careful about taking this kind of work to policy. I have some experience in competition policy. And in competition policy, there is a huge empirical literature and theoretical literature on different effects that one may want to take into account. The first thing the policymaker or his advisors need to do in facing a particular case, a question of what to do in some concrete situation, is to figure out which of the many animals in the zoo of models and in the zoo of structural econometric estimations are relevant for this particular case. And that's an activity of which I've seen too little, partly because it's dominated by, in practice, it's dominated by political economy. This was the German example I gave. And partly because both the practitioners and the academics have too little routine in them. Now, on the example of monetary policy, I was a bit shocked that this was taken, that the usefulness of the simple rules and models was taken for granted, given that for the past 15 years, policy has been groping in the fog. We had enormous monetary expansion, at least according to some measures, in the decade after the global financial crisis, without any of the inflation that was predicted. We had knee-jerk reactions to the inflation that came in 21, 22, maybe going away or not, without much appreciation of the fact that at least some of this inflation had to do with micro effects of macro dimensions. supply chain dysfunctionality in the relation to China, oil prices, food prices. All of these have nothing to do with the things we see in standard monetary models. I would submit that monetary policy has had too much automatic reaction to what was going on without considering whether the special circumstances of the processes that were observed might not merit a different analysis.
Thank you very much, Martin, for that. I don't think we want to go into monetary policy at this stage, but I think your point is well taken. I think the point you wanted to make is also to be parallel with, of course, with the models on macroprudential policies. So let me open up the floor for the remaining 15-20 minutes for questions, comments, and you can tell me if you want to address your comment question to a specific panelist or just to anybody. And I assume there's a microphone somewhere. Yes, there's a microphone. So I can't really see very well from here with the light.
Shadows.
Yes.
Shadows.
Yes, okay. If you can also introduce yourself quickly first. Thanks.
Gediminas Šimkus from Bank of Lithuania. Actually, it was very interesting to listen to Martin Helvig's presentation, and the way I'm from financial stability, my origins are there, so and they implemented the financial stability setup in Lithuania starting 2012. I do believe macroprudential policy works, and it really works. And they see it, and I will have a chance to present the results in an hour or so. But the question to Mr. Helvig would be that I heard it in a way that everything is impossible or useless. But there's saying that everything is possible, even what's impossible. So in a way, question is how do you see what's possible or what needs to be done, to fix the effects of macroprudential instability? So, or is it just hopeless, in your view?
Okay, thanks. Let's maybe collect some more questions before I give back to the panelists. Sorry, yes.
Ernest Knan from Swerve. Thank you for this interesting panel and the really illuminating presentations. I want to link up on Professor Helvig's point that contagion risk is very difficult to predict. And Professor Helvig gave a number of reasons, which all sound pretty psychological and like behavioral economics. And my question both to the panelists and also to Javier is there any work that tries to incorporate such psychological behavioral economics aspects into the modeling? Thank you.
Okay, thank you very much. Yes, yeah.
Yes, thank you. Maria Nykänen from the Bank of Finland. One question regarding buffers, because sometimes, when chairing the board of a FinFSA, which is making the macroprudential decisions for Finland, is that there's this kind of not maybe disagreement, but this kind of interaction between micro and macro supervisors. And when thinking about this idea that could be cover everything by putting adequate capital buffers by the micro supervisors and leave this quite cumbersome discussion and theories on macro buffers just to in a way, not to put that into practice, but to cover everything and handle everything with micro buffers. I'm not in that opinion, but I just would like to hear whether there are arguments for having these macroprudential policies and buffers in place. Thank you.
Thank you very much. So let's maybe go back to the panelists, and let me again start with Martin. Is all we have left hope?
I don't think it's entirely hopeless.
Thank you. Thank you for that.
One needs to ask to make sure that the right questions are being asked. And I think the US example I gave is an example of the right questions not being asked. So my suggestion would be to actually have some independent institution, something like the ESRB comes to mind, although the ESRB is more something like the Diet of the Holy Roman Empire, that actually studies the question, where could the systemic risks be coming from this time around? Knowing that that the underlying macro factors and macro risks tend to be the same all over, but they may come in different guises. Separate that from the actual policy analysis. On the policy question, the question concerning the relationship between micro and macro is one where I tend to side with a commentator on a previous lecture I gave on systemic risk, saying, this is also complicated. Why not have a high capital requirement, possibly non-sensitive, and then forget about the macro implementation? One argument for that is it's discretionary. The macro implementation tends to be discretionary, and that's fraught with political economy problems. In the discussion so far, much of it was really about bank regulation altogether. And the specific aspect that macroprudential regulation, at least the cyclical, so-called cyclical part of it, requires discretionary interventions, discretionary choices, did not play much of a role. I think that's the real problem there. The problem about the discretionary interventions is also a legal one. We are talking about something that happens under the rule of law, and if there is too much discretion, the banks can say this is not a well-functioning legal regime and complain about that, or rather they won't complain, but instead lobby against decisions being taken. But that's an institutional question that needs to be considered. On the side of monetary and fiscal policy, the question is, to what extent do we really want the macro-pru concerns to enter those considerations? Should Volcker not have turned monetary policy around in '79, anticipating that this turnaround would cause the S&L crisis? Would anyone seriously? But that's basically the issue that we're talking about.
Yeah. Thank you, Martin, for this. So also on the, of course, on the role of the ESRB, I see that Thomas Peltonen is taking careful notes. I guess the other argument that you made, Martin, I think this goes back to the perpetual discussion on whether we want to have just a very crude, automatic kind of buffers like the leverage ratio, or we want to kind of carefully fine-tune it according to the risk and then also try to influence incentives. Of course, knowing that, again, there's political pressure, there's reaction by banks, there's arbitrage possibilities and so. So I think that's probably a discussion that will be with us for still many years to come. Let me turn to Enrique, maybe next. There was a question on the contagion effect, and then of course the buffer question.
Yeah, so I think the two questions are very important. The contagion point is important. I think it is a question whether you can prevent it versus whether you can manage it. And managing it has to do with exposure. So the exposure to contagion and the question of systemic risk come together. So looking at the experience of emerging markets, that is the experience that I have looked at more carefully. For instance, in the context of currency markets, what places like South Korea have done with managing the positions of financial intermediaries and corporations to foreign currency lending. So you cannot control that if there is a crisis in Southeast Asia, there will be a tendency for markets to run out of Southeast Asia collectively. But you can manage the risk that financial intermediaries within South Korea will have to charge changes in the exchange rate as a result. So you can manage exposure. You have to think about preventing completely the phenomenon of contagion.
So Ernest was asking, is it actually something that is being modeled? Can we also include this in the quantitative model, this kind of behavior?
Oh, yeah, well, it depends. So again, like with everything with economists, we have many explanations for these things. So we have models of what is so-called rational contagion. So I did work on these things back with Guillermo Calvo in the early 2000s, which was about this question, the incentives that larger globalized capital markets have for the gathering of information. So contagion in those environments results from a rational decision not to gather information. So what do you do normatively? What do you do with policy about that is related to the point I was trying to make. You can manage exposure to that contagion. As long as you have integrated financial markets, it's difficult to say you can prevent it completely because the incentives to gather information on a globalized capital market are weaker.
Thanks. Before I go to Ricardo, actually, Javier was asked to do some extra time, overtime now, also answering this question from Ernest. So as a good academic, you don't mind, I know. If you can give a microphone to Javier, please. Thank you.
Thank you very much. Also, because I had some notes here wanting to elaborate on some remarks. I found the three panelists extremely interesting in their talks. I would like to first endorse what Enrique mentioned on not working in silos. I think that for too long, economics has a tendency to work in silos. And the same way, in a sense, macro has to be open to banking and finance and vice versa. I think those doing quantitative models have to work under the discipline of the evidence, maybe in reduced form, that these multi-country or single country but microdata studies tell us. And I'm confident very much in the gains from that interaction. So again, the same way I was saying, let's not kill the programs in our institutions that are working on dynamic macro models. Let's make the people working in dynamic macro models talk to the empiricists, because in a sense it's the way to validate that the macro model is capturing like a first order type of effect and is properly working. So I see future, and this is connected to the question on can we incorporate psychology? Well, first we need evidence that psychology is of sufficient empirical relevance to the matter, and then, yes, I mean, economics is so rich that you could have it. Would you have it in the mainstream model, in the main model, if there is one that you use for your analysis? Probably not. But I'm always saying that we should use a collection of analytical tools to support policy. I think this is also, Enrique's mentioned in the context of monetary policy. It's not that we have the model, we plug the numbers, we get the answer. Different groups will give us different types of analysis. I see that the type of quantitative macro that Enrique does, or the type of models, maybe more detail on the banks that my co-authors and I do, are complementary to top-down stress testing, which I think should be a regular tool for macroprudential supervision, complementing the more micro bottom-up tools. And then all this issue of the narratives is also important, of course, no? Because no model is going to be so detailed that is going to have a particular war between country A and country B represented in the model. or the issue of contagion is easy to capture in simpler models, but it's very hard to capture in the mainstream model. So the mainstream model will have a tendency to incorporate many of the developments that come out in the discussion at committees, in the narratives, also when we develop narratives for the adverse scenario of the stress test, that for the model are just shocks sufficiently many standard deviations away from the mean. And I think I will call for models with a rich stochastic structure that then brought to the data would allow us to calibrate the variances that matter the most, and in a sense maybe can reconstruct which sequence of shocks in the historical experience through the eyes of the model have taken us to a crisis. So I think that this model I dream with will be one that, when judging the events in the US around February, March, will say interest rate risk matters. In the 2008 episode, it will be housing-related triggers, et cetera, et cetera. Maybe I'm taking too long. The second point to say, maybe to rubber stamp, also some remarks by Martin. I think, and it was in my words this morning in the written version, but I couldn't pronounce them. I very much believe that under this view that macroprudential is, I think Enrique said, a dimension of our way of seeing things. Institutions such as the ESRB, even if not exercising hard powers, by putting together authorities from so different backgrounds, both in terms of nationality and area of competence, and regularly talking about this, can help coordinate not just the management of the tools, but also the diagnosis of the situation and the other very complicated dimensions, political economy, etc., that need to be taken into account. So I think, for instance, the ESRB was very important for European response to the COVID crisis to be expeditious, and thanks God we don't have now a COVID crisis with a financial dimension in our history.
Thank you, Javier. Let me turn to Ricardo. Maybe also, remember you had in your presentation actually a slide on the kind of macro-pro policies, but then also the communication and the implementation and so on. What coming to Maya's question on the, is it all we need capital buffers and the rest is just nice icing on the cake?
So I think that was a great question, and it goes back to the objective of macroprudential versus macroprudential. From a macroprudential perspective, you're focused on safety and soundness, right? And I mean, to put it like in a narrow sense, you don't want the bank to fail. From a macroprudential perspective, you don't want that bank to fail, but you want that bank to be a source of resilience in a period of stress. You want that bank to continue lending. So it adds another dimension to this question. So in terms of buffers, I mean, going back to the empirical evidence, during COVID, I mean, banks didn't fail, but did they continue lending? And that's where the question is still out there. Did the buffers help the banks to ensure that they would continue lending in this period of stress? And that's what's key from a macroprudential perspective. So as I showed in the empirical evidence, I mean, there's mixed evidence on that. It may be that some buffers did help. In some countries, the CCYB, when it was relaxed, helped those banks to continue lending. In other places, even though the supervisors told the banks, you can use the buffers to lend, that didn't work as well. So some segments of borrowers were not getting credit from the bank. So I think that's what distinguishes the two a little bit, and that's why calibrating and thinking about the buffers according to what's the objective, it's key, and that's where macroprudential and microprudential supervisors have to talk to each other to assess what's the right level of calibration, maybe using the models that are out there, depending on the objective that they want to satisfy. And very quickly on the contagion question, as Enrico was mentioning, I mean, there are models out there that have modeled fire sale risk externalities and things like that, and there are clear mappings between that and data. And for some markets, I mean, there are monitoring tools that can can be used to monitor whether there are vulnerabilities in sector markets, that if the psychology is there and there's a trigger, you could assess whether there are sufficient vulnerabilities that could lead to something bad. The problem is that we don't have data for a lot of markets. So for the corporate bond market, we have detailed data where we can implement some of these measures and capture the vulnerabilities. For other markets, there's no data. So the models are great, but if you don't have data, you cannot monitor those markets in a consistent way.
Thank you, Ricardo. As you can see, he's a very good empirical researcher. He ends his intervention on asking for more data, so always good. Well, I think this brings us to the end of this session, because I'm standing between you and lunch, and that's a very uncomfortable position to be in. So I'd like to thank my two panelists here in person, Enrico and Ricardo, and of course, especially also Martin, who has come in remotely, and would like again to join me in thanking the panelists.